Welcome back to the Deep Dive. Today, we're cutting through the noise with market intelligence from around November 29th. Our mission is to figure out why defense is, well, the prevailing strategy right now.
It really is. The source material is clear. We're seeing this persistent pressure on global risk assets. And it's all coming from high interest rates and tightening liquidity.
Okay, let's unpack this. And we have to start with the bond market, right? The yield curve. It's waving a massively inverted flag.
It's a critical signal. Look, the U.S. 10-year is sitting at 4.13%.
Which is down a little.
Right, a bit of a reassessment on long-term inflation.
Yeah.
But the 2-year is still way up at 4.91%, reacting to the Fed's, hawkish stance.
So you put those together and you get an inversion of about 78 basis points. That's not a whisper of worry. That's a foghorn for a coming slowdown. Or a recession, frankly.
And that immediately translates to pain. It's what we call discount rate pressure. All those future earnings for tech companies, they're worth a lot less today when rates are this high.
So it just crushes valuations for high-growth tech and a lot of crypto assets. Caution is mandatory.
Absolutely. And then there's the actual cash supply, the liquidity.
Right. What's happening to the money flow?
It's not supportive of a rally, full stop. You've got the strong dollar with the DXY at 104.5. And the M2 money supply is just slowing dramatically.
And all that cash sitting on the sidelines in the reverse repo facility.
Exactly. The RRP balance is still a huge $1.55 trillion. That's liquidity that has been pulled out of the system. You just can't get a sustained rally without that fuel.
So given all that, what's the mood? The VIX, our fear index, is at 19.2. That's a concern, but it's not outright panic.
And the crypto fear and greed index is around 52. So just leaning into greed, but feels fragile. There's no major catalyst to overcome the macro gloom.
So the macro picture is set. High rates, tight liquidity, low risk appetite. The playbook says lean defensive.
And you see that playing out perfectly in the major indices. It's a clear divergence.
Yeah, look at the S&P 500 ETF, VOO. It was up 0.3%. That tells me money is rotating into safer sectors, utilities, healthcare, that sort of thing.
But then the NASDAQ 100, the QQQM, was down 0.5%. That is the discount rate pressure we were just talking about, hitting high-growth tech right where it hurts.
And that pressure spills right over into digital assets.
It does. It can't escape gravity. Bitcoin's pulled back to $29,000. It's suffering from low spot ETF inflow, and it just lacks a powerful narrative right now.
But Ethereum's holding up pretty well.
Yeah, ETH is steady around $7,710. It's supported by real, solid on-chain activity. Solana, though, is a different story. It's hanging around $24, but it's a high-beta asset. In this kind of environment, it carries significant risk.
Okay, let's get into specific companies, because here's where it gets, I think, really interesting. You can see who the market trusts when money is expensive.
You really can. The pressure separates the stable cash flow businesses from the more aspirational stories.
Take Tesla. The stock is just so volatile. Even with a decent earnings beat, it can't escape that valuation pressure.
Compare that to Google, which is relatively strong. It's got advertising and, crucially, the AI narrative. And then there's NVIDIA.
NVDA is expected to just keep climbing.
Because companies have to spend on AI infrastructure, high rates or not. It's non-negotiable CapEx. And that flows right to NVIDIA's bottom line.
That strong AI focus brings us to the frontier. Pre-stocks on the blockchain. Valuations for, Anthropic, OpenAI, XAI. Why should we even pay attention to these?
Because they're a real-time emotional barometer. Anthropic is attracting capital, its valuation is optimistic. It suggests some investors see a future that completely overrides today's macro problems.
So it's a conflict. You have the hard data screaming caution, and then this pocket of the market showing wild optimism.
That's the key tension. The numbers don't lie. The 78 basis point inversion is real. The strong dollar is real. The Bitcoin to gold ratio at 0.89 suggests BTC is expensive relative to a traditional safe haven.
But then you get a news catalyst. And this past day had a big one.
A huge one. Amid all the gloom from Powell staying hawkish, you had OpenAI partnering with the Solana chain to release pre-IPO tokens.
And that just brought a massive wave of attention and capital right back into SOL, completely ignoring the macro fear, at least for a moment.
Right. So it shows these micro-catalysts can still create powerful, if temporary, pockets of activity.
Okay, so let's wrap this up. What does this all mean for you, the listener, trying to navigate this?
The overarching theme is caution. The pressures are real. Risk assets, especially high valuation ones, face significant headwinds. Defensive assets are just more appealing to capital right now.
And this is the big question to leave you with, despite all these clear macro signals pointing toward recession and defensive plays, you have the blockchain's pre-stock segment showing this incredible optimism for AI.
So when that macro reality, the bond curve, conflicts so directly with that future-facing, chain-based optimism, which signal is the better long-term indicator of where capital is really going?
Should you be watching the old foghorn of the inverted bond curve or the decentralized excitement for XAI and Anthropic? Something to think about.
Definitely something to mull over.
Thanks for joining us for this deep dive. We'll catch you next time.